What is poppin'? It is a slapped and I am but a lowly slapped in riding these Refi waves. And this is This Week in Refi, where we give you all the Refi news that is fit to go ape wild over. Of course, with me is the man with the tan, the man with the plan. I had that backwards. The Estonian madman, the man of the hour, the man of the power, the man that's so sweet he's never sour, the leader of the regenerative finance vanguard, Sir Rez.
Hello, it's me.
I add one more thing every week.
I feel like I'm getting more pompous every week. It's not a good look, man.
And you know what, man? You need to update your LinkedIn profile because I don't see any of these titles under your LinkedIn.
Oh god.
I don't
Oh
see.
yeah, it would be just like, and no, I would just like shorten them to like very hard to figure out abbreviations, Man of the hour would be like
Moth.
moth, yeah, just like all caps moth, and then you're just going like, what is moth? Like is
An
okay,
insect. He's
sure.
an insect.
Yeah, I'm an insect, yes.
Cerez, we have a lot to go over. We're going to talk about primarily, actually, almost solely, the difference between the Verra Consultation process and the gold standard consultation process. Lots of talk has been going on. There was a meeting. What was it? The Zurich meeting? I forget the name of it already. We're just looking at it.
Zurich Carbon Market Association.
Zurich
Yes.
Carbon Market Association. Gold Standard was there, made some comments, and there was an article published in, what was it, Quantum
Commodity Intelligence.
God,
Yeah,
so much to remember. Quantum Commodity Intelligence about gold standard. So a lot of people talking about this. This is obviously on the tips of everybody's brain. So we want to go over the difference. We want to like say our piece on this. You've thought extensively about it. You've responded to both. So that's kind of that's the deal for This Week in Refi. Before we get into that, of course, though, we would be absolutely remiss if we did not talk about the best job board in all of Refi, RefiJobs.com. It's right there in the name, RefiJobs. You want some? Go get it. Curated jobs. Do well and good at the same time. Make it happen.
Yes.
Cool.
Yes, come and get it.
Come and get it.
Yeah, come and get it.
Come and get your Refi jobs.
Yes.
Come and get your gold standard consultation.
Yes.
We've talked about this before.
Quite a lot. Yeah, we've had a few episodes where we talked about the webinar, we talked about the launch of the consultations for both. We even talked about both of the webinars, if I remember.
Yes.
So we have been commenting on this the whole way through, but what has changed now is that finally I put in the work for both to come up with a full response to both, and I now have a first-hand experience of responding to both and how it made me feel and what the outcome of both of those consultations were in terms of my response to them.
Cool. So where do you want to start with this? Do you want to just start with the differences? I think there's one stark difference that we had mentioned off air, which is just the length of them, right? Which is something, not always the case that the longer one is the better one, but gold standard is over twice as long as the Verra one. Verra's 6 pages, like not even 6 pages. It's like
it is 6 pages. Yeah, it's like 5 pages or something compared to, let's say, 16.
Yeah.
And what also is surprising about that is at the same time, the Verra one manages to be much more opinionated in kind of strange ways for me, compared to the gold standard one, which was, we've spent time thinking about this. These are our arguments. We would like to hear what your thoughts are, what is the possibility, etc., on a bunch of different categories. It felt like the gold standard one was a lot deeper in how it was structured. It had asked a lot of really good questions, and I actually started the Verra one first, then started working on the gold standard one, and because the gold standard one was asking such nice questions, I had to go back to the Verra one and then start changing things because I realized that the way they were shaping the conversation made me consider factors that I had left out of the other consultation entirely. So it was a very stark difference for me.
That's interesting. So what are some of the things that gold standard made you think about or reconsidered? What was like your original viewpoint, and then it got changed because you had put more thought in, prompted by gold standard?
Yeah, so like the whole thing was that the Verra one essentially had this term of what basically amounted to recursive KYC, which was quite strange. So the specific wording was, let me find this. It was something like, if you hold the token, you should be subject to KYC. If any other token contains the token, then you're subject to KYC. If any token of that token, is somewhere, then it's subject to KYC. So it's sort of this like recursive KYC requirement, which on a technical level just made me have an aneurysm, quite frankly, because it seemed to imply this sort of like requirement for a technical solution, which I personally, I don't know about you, have not seen in the space in any form. Like, have you?
No. So one thing, like I'm doing it now on the screen, if you people are watching the video, is just Control F, finding all the mentions of KYC, and it is replete. That is, I was talking privately to some people in the regenerative finance space, and one of the things that I've noticed is if you're actually listening to what Verra is saying, like I get the sense that people are hearing Verra, but they're not, or listening to Verra, but they're not hearing one or the other, right? Like they're hearing the words, they're seeing the language, but then they aren't really grasping the thrust, which I think is obvious to me, right? So this document has a no less than 11 mentions of KYC, right? And if you read the context, it's saying that it wants all tokenized platforms to have KYC. It mentions that it's
everything that touches everything,
right?
Everything that touches everything has to have KYC.
And then, I hear people in the space saying, "Well, we really don't know what Verra is going to do or what they want to do," and I'm just kind of flabbergasted by that. It's like we do know what Verra wants to do. Whether they do it or not is another thing, but we know very well what they want to do. They've been saying it. It's just that maybe you're not listening, or you don't want to believe what they're going to do because you don't like it. But this, and if you listen to their webinars and things like that, this is a big piece of a component of what they want. They want KYC. And if I were a betting man, I would bet that whatever they're going to roll out is going to have some level of KYC that most people in Web3 aren't going to be comfortable with, and probably won't allow for the anonymous nature that we've been accustomed to in regenerative finance thus far, almost to the point of it being a game breaker, right? Like where you just don't want to play the game because it's going to be so prohibitive, not only from a moral perspective, but as you said, a technical perspective. How do you do this? How do you KYC, let's say, a derivative?
Yeah.
Right.
And how do you enforce that? Like that's it ends up being a lot of these questions, which I think you have to keep in mind is it's not only people and companies that would hold carbon, right? It can be contracts. It could be smart contracts that have, their own assets. And a good example for the people of Web3 would be, for instance, liquidity pool tokens. So liquidity pool tokens contain, for example, if you have a dollar carbon liquidity pool, it contains dollars and it contains the carbon. So if you redeem them, you can get out the carbon and you can get out the dollars. So who exactly needs to get KYC'd for the contract to be allowed to hold carbon, for instance? Or if a contract is spun up, how would it even go about getting this sort of KYC? How do these nice systems that we have, how would these interface with them? Because it doesn't feel obvious to me. And it also raises these kind of very annoying questions of, for instance, let's say Klima has carbon in their treasury, right? So does that mean that this would imply that every single person that also owns any Klima tokens should be subject to KYC because there is carbon in the treasury? It like keeps rolling like this, and it was kind of hard to figure out where does the line stop if you have this kind of recursive system in an otherwise permissionless, context. And what would even be this technical approach that would allow you to achieve this? So that's what I found to be kind of annoying. The second half of this is retirement, because in the Verra Consultation, they explicitly said that they want all beneficiaries to also be KYC'd. So this means you couldn't even on-chain operate a sort of anonymous retirement aggregator a la, the Klima retirement interface style thing without having the person also offsetting be KYC'd. And now, why is this a problem, you might ask? The problem comes from the fact that there are a couple dozen off-chain carbon offsetting service providers who aren't subject to these requirements whatsoever. So the biggest one, I think, might be these organizations that provide an API. So you, as now this user of, for instance, Patch or Cloverly or these kind of APIs that allow you to just call a line of code which retires carbon in the background. You as a developer can now integrate this into your service, and then, for instance, have checkout flows where you are providing carbon offsetting services for the goods that people are purchasing, or the offsetting the logistics, offsetting this kind of stuff. They're like, the API provider doesn't know who they're offsetting on behalf of, much less Verra, right? And this is just purely on an electronic level. We also have just the standard third-party registry operator model, where you might have even, let's say, South Pole or a large consultant who comes in and works with you and offsets your carbon footprint. They don't necessarily have to give that information to Verra. If you, if you read the retirement messages for Patch, these are basically, it just says retired by Patch on behalf of its customers and their users, or something like this. And it's like, who can audit that? Who can even make claims on that basis? And this has been happening for years, and it hasn't been problematic in any form. Like, fundamentally, if it isn't like a huge organization making claims about their footprint, why does this functionally matter? The Verra comment made this sort of strange reference to a sort of fraud that can occur. And I was left looking at that and going like, I can't figure out how to do fraud. Like, what does the fraud look like? And why can it happen here, but not everywhere else where it's been happening for like this sort of no explicit requirement to know the ultimate beneficiary? Why in those contexts hasn't that fraud already happened, and why do I not know about it, and why isn't somebody cracking down on it already? I ended up with a bunch of these questions, and I couldn't figure out for the life of me of where does the fraud come into this picture, because it was never explained. Yeah. So, if we're going to go down the route of KYC is required to hold, I don't think it should ever be KYC is required to offset, right? If you want to call some sort of a contract that offsets, for instance, like a sushi swap, retirement contract, that shouldn't have this built-in requirement that, no, you are never allowed to touch carbon even for offsetting purposes. Like, there can't be retirement interfaces that make this easy. None of this can exist without a, explicitly KYC system. And that kind of felt weird to me, because we have these examples, as I mentioned, that don't have this requirement. So what is happening there?
Yeah, I'm also at a loss for a couple things you'd mentioned. Is what is the fraud specifically, right? I think it's problematic. I hate using that word, but I have stronger words that I'm not going to use here. I think it's problematic to just throw around words like anti-money laundering, fraud, because to me it just is like these buzzwords that should compel you to think the way that they think, because it's a serious matter. It's like, no, you actually have to explain how it happens, right? Yeah. You can't just throw these scary buzzwords around and then say, and this is why we're doing it. To your point, how is not knowing the beneficiary of a retirement in any way related to fraud?
I don't know. I think perhaps the only kind of fraud that you could have is when you retire offsets. Let's say you retire 100 tons, right? And two different organizations say, hey, that was me, right? That would be a problem. this also currently happens in the registries. Like, you know, these. I would like to see a world where we have a provable central authority on who actually was the offsetter, but this is currently not the case. So if that fraud actually is significant and serious and happening, like can happen, it's happening right now, even with the tokenization ban in place. So I think it's a sort of way to address a problem that might emerge in this space while completely ignoring that it's already happening. And then I end up with this question of why is a technology specific solution necessary here if it seems like the problem itself is technology agnostic? If this thing can already happen, it is happening. Why is it getting solved only in this like 1% of situations in a way that actually privileges the status quo to keep being like it is?
Yeah. And so, okay, that's a fair point. So you're going to say that, you know, we're not going to be able to we're not going to be able to figure out who retired what credits, right? Because you and I can both claim that this transaction was we were the beneficiary of it. Okay, so that's one thing. So what was specifically said was something like anti-money laundering, crime, particularly, right? Again, I don't get it, right? That was explicitly stated, as far as my memory serves, in the webinar. It's like how
this one I actually can like address, and I think it's true to some extent.
I agree. To some extent, it is. Yeah. Go ahead.
I think anti-money laundering comes into question when assets move off and on-chain. This is generally an area where if you know that, for instance, exchanges will check your dollars to make sure that they came from, you know, not weird places, but for instance, there was a path to Tornado Cash a bunch of money, buy a bunch of carbon, and then go to, for instance, you know, a Toucan or this kind of organization and say like, hey, allow me to bring this off chain. That would be a way to money launder if there was no checks in place to say like, no, this is sanctioned money. The asset itself isn't very problematic, but you as a participant in the system, we need some additional checks here. I get that. I really do. Like, that makes a lot of sense to me. But the more of a question is, how do we make that fit into the larger scheme of things, right? Because sure, these things can happen, but we also have seen answers to this that haven't required fully closing down literally everything as a consequence. I think the main example of this would, you know, be the stablecoins, USDC, USDT. These exist on chain. There's a freeze function. You can call a freeze function. You can just freeze somebody out of their assets. Is that cool? Not really. Does that fill the legal requirements of, you know, allowing USDC to exist in the meanwhile? It completely does. And I think that's a really important thing that we shouldn't be forgetting, is that we do have examples of how some of these things could work on chain, even when with their real world assets and subject to some sort of laws.
Okay, so that would be, now that's where I would agree. I would agree that you could have some sort of money laundering in the transfer on and off a chain, but it goes back to the original question of how would that play into needing to know who the beneficiary of a retirement is?
Yeah, that's the question. The beneficiary part is honestly the most egregious overstep, in my opinion, because you could make the argument that people that hold carbon are already subject to some sort of, you know, KYC currently in all other systems. You could make that argument. Like, I don't necessarily think that you would be too wrong. I mean, there could be third-party registry operators that own registry accounts and then hold on behalf of somebody else who might not be KYC'd. But that's more of this niche case that, you know, it can happen. But also, coming back to the thing you asked me before, which was what did Gold Standard ask, which changed my thinking about things. It was around this question. So the question they specifically asked was, what are examples from other spaces that we could learn from?
Good. And is that something you had to dig into and willing to share?
Yes.
Good.
So I ended up looking around at a bunch of KYC solutions. and there does seem to be like an emerging, space for on-chain KYC in the first place. I think a really good example of this, if people are listening want to try out what a on-chain KYC process might look like, is Goldfinch. Have you ever heard of Goldfinch?
I've heard of it. I've never interacted with it.
Yeah. So I finally interacted with it, and actually the experience was quite smooth. No complaints from me. Essentially, because what Goldfinch does, it's a decentralized finance protocol for financing credit lines to developing countries' economies. So generally, these are areas where traditional financial institutions shy away from. So they just don't want to extend credit lines to countries where they perceive them to be more risky, even if the money's there, which is annoying. So Goldfinch's solution was, hey, there's a bunch of people that would actually like to do this, but how do we let them? And because they are working with a sort of real world asset, right? It's the credit line. How do you do that on chain in a way that also won't get everybody involved put in jail? Because you might be working with these kind of assets that generally do require you to know something. They solve this by just having a very simple KYC process where they offloaded the actual work of figuring out who you are to these nice automated systems. So if you've ever interacted with a modern fintech company, you probably have seen these things.
Yeah,
Slapton. Yeah. The whole thing about like, okay, show us document from the back, show us it from the front. Yep. Yeah, you're KYC'd now. Congratulations. That's the kind of service that these organizations provide. They managed to integrate these into an on-chain representation. So it's an ERC 1155 token. It's essentially an NFT. You can view it on OpenSea. And what kind of information does it expose on-chain? It tells you if you belong into one of 5 categories. And the categories are essentially something like non-accredited individual investor in the US, accredited investor in the US, US company, non-US company, non-US individual. That's it. Yeah. And that's all they need to know, because they just don't want to step on the US's like SEC's toes. They don't want to put themselves in a situation where the SEC could clap them for existing. That's kind of understandable, right?
So that would be a proof of concept that we could apply to KYC measures for tokenized carbon credits.
Yeah, essentially the second example would be Centrifuge. So we talked about Centrifuge a while ago. They also have a very similar system, but they issue these sorts of I think I don't know the exact technical details when it comes to the Centrifuge approach, because they use this service called Securitize. I've heard that the Securitize onboarding flow is a lot more clunky, a lot less smooth than the one Goldfinch is using. But all of these options do exist to some extent. We just haven't had the need to make them like super nice, super smooth UX yet. But I do think there's this pathway to getting to a sort of on-chain KYC solution that at the same time wouldn't expose data on-chain, but would give enough legal cover so organizations actually could do the things that we want to do. And I think it's going to get better over time as we get, these zero knowledge proof style solutions coming up, where there's literally no on-chain information that gets exposed just to everyone. So you wouldn't even know as just a random person looking around on-chain if this person is a accredited US investor or whatever. That wouldn't be information you could get in a zero knowledge proof system. It's just that person in their transaction signs a thing that says, hey, I'm an accredited US investor. The other party receives it and they can check, but they don't know the underlying data. They just know that this fact is true.
Right. There is a proof that is probabilistically so unlikely that someone guessed it that there's a high level of certainty that who they say they are, right? So they're trading certainty for probabilistic certainty, and that's the trade-off. But it's a good enough trade-off that it can obscure the information and still provide assurance.
Yeah, exactly. Yeah. Because you would have to fake this for every single transaction, and it's not obvious how you would do that in like a cryptographic system. It's the same way, theoretically, Slapton, if I really wanted to, I could get access to your Ethereum wallet. just by
good luck.
guessing random numbers over and over and over again about finding your, these like nice, what is it, 16 words or 26 words or
I'm not telling you. I'm not telling you this.
Yeah, let's start finding out the number of words. But the thing is, where I ended up with that was I didn't want to go like, no, there's no examples that you could learn from. I was just like really legitimately went in and was like, this is a very good question. How are real world assets handled on chain?
Yeah, that's very good examples, and certainly things for people, myself even included, to dig into. So it seems like one of the key differences in the consultation processes, at least along KYC, is one party was asking for information and leveraging the knowledge of the community, and another party was explicitly saying we're going to or want to put KYC in a very oppressive form.
Yes.
Okay, that's one key difference.
Well, yeah, I mean, the gold standard one was like, give us your opinions. Well, the Verra one more felt like, here's our opinion. Do you agree? Yes, or also yes, or yes in Spanish maybe.
Yes, or C.
C.
Yes. Okay, cool. What else? What else popped up as a key difference or something that was worth changing your mind about or your opinions on?
Well, I read the gold standard has this interesting opinion on pooling, which I honestly haven't figured out completely why they have this opinion, and I think it generally might come down to some sort of a fear of how these things are being used. It might come down to some legal implications. I'm not that sure, but they did say that hey, we have this opinion about pooling. We would like gold standard credits not to be intermingled with other credits from other registries in pools. What do you think about this stance? And how, if in any fashion, could this be actually enforced? Which was I think like an excellent question, because my answer to the first was, I don't think there should be limitations on pooling.
Yeah, so just so let's be clear, define what that means.
Yes.
So like if pooling would be, the fundamental issue is that a carbon credit is not a carbon credit, it's not a carbon credit, right?
Yes.
We start with that. We start with the fact that there are different, we've talked about this last episode, we talked about it 1,000 times, right?
1,000 times.
Yeah. So the quality, how the market
can vary heavily.
Can vary, and how the market values them. So there's $2 carbon credits, there's $20 carbon credits.
There's $1,000 carbon credits.
Exactly.
There's a lot of different values of carbon credits, and they all theoretically should be 1 ton of carbon. But in practice, people value them very differently.
Right. So that creates the problem of non-fungibility, right? And in a liquid market, because you need some level of fungibility to have some level of liquid market. The solution, or a solution, would be to create parameters that would pool similar enough credits into a fungible derivative so that we can have liquidity and we can have price discovery and we can have price transparency. So that's pooling. All right. So what were you going to say about this in and of itself is a huge, I would say, problem or issue to solve. What are some of the challenges to overcome?
So they said something to the style of they aren't sure if gold standard credits should be pooled with other things. But on the other hand, they said that they understand that project proponents might want to pool things with other credits if it means they get money, right?
Right.
So, and my argument there was essentially, I think the free market will handle it very nicely. Essentially, if you can put things inside of a pool and you can take them out and put them in another pool, and the underlying credit is worth more, and you have opinionated demands that want specifically that credit, over time you will have pools emerge that are just gold standard credits, because gold standard credits have generally very good accounting practices. They're a bit more expensive to make because of this. And they're a bit more reliable in terms of 1 ton equaling 1 ton. So, because of all of those reasons, I think people would prefer in some situations to just want gold standard credits. And how do they do that? They will go to some sort of pools and get them. And if there was a cheaper pool and a more expensive pool, you as this rational economic actor in the middle could just take it out, put it in the other pool, sell the resulting token, and cash in the spread. And this would happen over and over and over again until you have a purely gold standard pool on one side, and all of the gold standard credits in the other pool are just kind of taken out over time. So I don't necessarily think that should be a fear that hey, these things are going to end up getting pulled. If they can be pulled out, then just put into another system where they can live their best life and have the most value to the end user.
And we've seen this. So first of all, I just wanted to say real quick, the invisible hand of the market.
Yes.
Adam Smith exponent, Rez. That's going to be your new title. Oof. Adam Smith, the economist, right? I think he was this rational self-interest guy, or he believed that self-interest is the best way for markets to organize themselves. But certainly, I mean, it's a compelling argument that assuming enough rational actors, and that is an assumption that we have to make, that the like quality credits will find themselves in discrete like pools. Exactly. And
exactly. If there's economic value that can be gained from the middle to arbitrage from cheaper to more expensive, people are just going to make money doing it until the opportunity goes away.
Yeah.
It bots, just means that you need opinionated demand on chain. It needs on-chain demand to exist in this form of people or organizations or DAO treasuries going, no, we just want gold standard credits because we think they're really good. Mm-hmm. If you have that kind of an opinionated demand where they have this opinion, everything else will just kind of handle itself.
Right. And so as a real-life example of this, and I don't bring this up in any malice, but we saw in the BCT pool higher quality credits when the NCT pool was spun up. Arbed out of and it was a big deal, obviously. But I mean, that if you want to conceptualize this, that is exactly what we're talking about, right? So if there's an opportunity to arb, and I'm going to use these words without any judgment, a poorly parameterized pool, people will do it, right?
Mm-hmm. Yeah, exactly. There will, over time, if there is opinionated demand, there will be opinionated pools. Like, it's just an economic inevitability, because either there isn't opinionated demand, in which case you won't really see them going anywhere in the first place, or there is opinionated demand, in which case these nice gold standard only pools will just come into existence on their own. You don't necessarily have to limit the project proponents, because if they wanted to get rid of a huge amount of credits and the price that the pool was offering was acceptable for them, they would just take it anyway, and then they would leave the arbitrage value to somebody else. That's fine too. But there didn't, in my head at least, seem to be this very good reason to limit it. Perhaps the only one would be this sort of what's known in the carbon space euphemistically sometimes as, I think, a blended portfolio of offsets, if you ever heard this term.
Yes, I love it. I love that term.
Yeah, sometimes I'll give you. Sometimes it does mean that, for instance, we want Red Plus projects. So instead of offsetting from just one Red Plus project, we're going to offset from 10. Okay, that makes sense. Sometimes what this blended portfolio approach means is that on the main headline of the blended portfolio, you're going to see a beautiful picture of like a forest being restored somewhere in the Amazon or something, right? You see pictures of monkeys. It's very nice. And then in the background, it's 2% these nice monkey and forest carbon credits and 98% Chinese hydro electricity credits for $2, but they cash in a spread of like $10 per offset because you got the market thing. It felt like you got the high quality thing, but in the background you were sold the high quality thing mixed with sawdust essentially, and they just charge you a lot for the sawdust.
Right. And this was so this is similar to the collateralized debt obligation packaging that happened in the subprime meltdown, where they took really good debt and really bad debt and they packaged it together and gave it an AAA rating and they sold those. It's the same thing. This is a
very safe.
Very safe. A trick as old as economic accounting, right? So that's a fair is a fair critique of doing that, that it absolutely can go wrong.
Yes, but it does happen in the market actively all the time, off-chain. Nobody seems to be going after this kind of an approach, even though I would accept that this is problematic. But it's not like there are any guidelines going like, hey, if you're a German electricity company, you aren't allowed to buy Chinese hydro and forest and just advertise that you're buying forests, right?
And I would add on top of it that with the ability now for market actors to have more agency to take certain credits and put them in different pools, which we do not have in the traditional world, that creates the incentive to make the pools align. Like the problem with the collateralized debt obligations is it was not an open market. It was permissioned beyond belief.
Yes.
So there was only a few actors who could interact with these things. You couldn't rebalance these pools organically, and you ended up with a disaster, right? So this is an argument for opening up these systems to more market participants. Like it seems to be whether you're a free market person or a centralized plan person, like there is plenty of economic evidence to suggest that the more market participants exist, the more rational a market will emerge. Right? So time.
Well, yeah,
it's not. It will never get to be perfect. I would,
Yeah, I think like meme stocks are a very good example of kind of this situation where the market can remain irrational longer than you can remain solvent. Right.
Well, there's a second component. I think it's time. Over time, markets tend to rationalize, and then over
because the irrational people will eventually lose money.
Exactly.
Eventually.
Well, it's the N, right? How many people are in the population, and then it's also the time. So if you can increase both of those things, you tend to get the most rational markets. Where you have the most irrationals in a short time preference, and also with few actors, because any one person can be highly irrational. The likelihood that everybody is irrational decreases, never to zero, though, as we're well aware.
Yeah.
All right. Good.
And I think like to a last follow up, because I do want to expose all of the knowledge that I have on this topic, just so we would, be discussing this on reasonable terms. In the last carbon credit boom, which I don't know was like in 2000 and
okay,
it was before the Great Recession. Okay. Let's put it this way.
Yep.
There was a time where carbon credits were hot for a moment. And during this period, actually, carbon credits, really shitty ones, got sold to pensioners as a sort of good investment. And, I think that's also what makes these registries a bit hesitant in general of getting more retail involvement, because they don't want a repeat of that fiasco again. And I kind of can see that, at least from some perspective.
I've got a solution to this. The registry should make sure that the quality of their credits aren't garbage. And if they're so bad that they're embarrassed by them, they should pull them off of the market. And not blame the people transacting them. That's
HFC 23. Yeah.
Right? That's my opinion. But okay. Anything good. Those are two really good points. Let's do one more. We have time for one more. If you have one more. Anything else jump out to you?
Both of the comments had a lot of talk about energy use, essentially, of blockchains, but I think this was written in a time, in both cases, where Ethereum was still proof of work. And the main point that I tried to get through there is just the fact that if we're talking about now modern blockchains that even have smart contracts, so they can handle your, transactions with things that aren't the coin being transacted, in case of Bitcoin, we literally do not have a single proof of work blockchain that enables smart contracts and that is relevant. It doesn't exist anymore. Functionally, yes, you could ban proof of work blockchains if you wanted to, but it won't do anything. Like, there are no proof of work blockchains that people are using anymore. Like, I guess you could make the argument that, Ethereum Classic and the new proof of work Ethereum fork or something, like, both of these are incredible flops. They're not relevant. And anything else is proof of stake. The transaction costs in terms of energy are very low. We're getting down to a point where if anybody wanted energy efficiency to that degree, they should already also be asking, traditional exchanges to, hey, how much energy are you using? Because we're approaching that kind of an area where energy efficiency is more in line with the rest of the market. It's, Ethereum is no longer requiring the energy use of a small developed nation. That's not the case anymore. So I don't think the whole energy use discussion is that relevant anymore. Though, if either of them do want to enforce some sort of a carbon neutrality requirement for the chains that the tokenizers operate on, I would be completely for it, because it would just be another source of demand for carbon offsets. The chains would have to offset. That would be dope. Like, why not? This would be a completely self-interested move on the part of carbon registries, and I would be all for it. Why not? But and the blockchains would do it 100%. You know that they would do it.
Yeah.
Every single blockchain project just wants more users, and they'll do anything for it. Like, if it guarantees them that they'll have some more use cases that they can tell their token holders and shareholders that, hey, we're also now doing this, they'll be super excited for it. It's gonna happen.
Yeah,
so
right.
if they required offsetting or being carbon neutral or even being carbon positive, go for it. But it's not because of blockchains now being inherently bad for the environment.
Yeah, that's it, man. Blockchains. What's the product of a blockchain? Block space, right? That's what they're selling.
Block space.
How do you have more? How do you sell more block space? More applications, more users.
Yep.
So
exactly.
Yeah.
So they would be all for it. Functionally, go for it.
We are getting to
and
the point.
I think maybe the last thing is that both of them propose different models for how tokenization should happen. The gold standard one, they were proposing initially having a sort of custodial approach, where people, these organizations that were tokenizing, hold the underlying carbon credits in a sort of custody account. And Gold Standard was super into having a two-way bridge. That was like what they wanted, very explicitly. They wanted the ability for carbon credits to enter and exit tokenized systems. I'm super excited about that. When it comes to the Verra comment, they wanted to have this sort of like immobilized state, which is, I would say, retirement adjacent. So essentially, instead of calling it retired, it would be immobilized, and then it would exist somewhere else. And then maybe it would go to retired once somebody on chain actually uses it. But Verra wasn't very explicit on whether or not they would even like to see two-way bridging. There was a whole comment about, do you think even two-way bridging is needed? Which, well, of course it is. I don't see how it wouldn't be, but I'm sure some unknown trading organizations that manage the sale of carbon credits to a bunch of people might say that no, you're not competing with us. No, we don't want more people in our market. No, that's bad.
Yeah,
and most people will probably write like, no, it's horrible. Just never. No.
Yeah, I mean, all good points. So I appreciate your insight into that. I'll say it. I'm way more bullish on Gold Standard than I am on Verra. Obviously, I think that's been apparent. Just based on the consultation period, the language being used, the approach. I think at this point, the likelihood that Verra will spin up anything that we, the Refi Web3 people, will enjoy or think is in line with our values is close to zero. I don't think it's something that I'm looking forward to. And I think that Gold Standard will likely give Refi some of what we want, but unlikely all of what we want. And I think that's probably reasonable. I think we still have to accept that the values and aims of this space is not just revolutionary, but to some extent extreme. It's on a very far end.
It's sometimes exactly. It's sometimes antithetical to a lot of this like KYC talk is antithetical to blockchain, but it's it's just part of the course in real world assets. So it's a bunch of it ends up being this kind of negotiation between, if we have a real world asset on chain, what is like the minimum requirements that should be enforced. And Personally, I would super be excited for having this sort of USDC style system where a freeze is the only way of control. That would be really great. It would mean that we could integrate with everything without a lot of significant problems coming up, and essentially these registries could just maintain a list of things that they wouldn't be okay with these tokens being used for, and then if that happens, these addresses would get essentially blocked, right? So it's a sort of ask for forgiveness, not for permission it's a type of system,
right?
But I'm a bit hesitant to say that this has like good odds of happening. I would like to see it happen. I don't think it's the most likely outcome.
I agree.
The most likely outcome for me currently still continues to be a sort of allow list style system where something needs to be done in order to get into that list. But I think there's just a lot of uncertainty about how to handle smart contracts in that kind of a situation. If you have a Uniswap pool or you have a Sushi Swap pool, are the pool tokens supposed to now comply with some sort of requirements? If so, then what? Are multi-sigs supposed to be KYC'd? How do you KYC a multi-sig? Please tell me. I would like to know. This would be very interesting to know. But a bunch of these questions, these will need to be answered in order for the system to make sense. But I would at least hope we just get some guidance, and then it's going to be fine.
I think it's going to be out fine. I think ultimately we're going to make it, and I don't say that like facetiously or flippantly. I think we will. I just think it's going to be much more circuitous, and it's going to be not a straight line by any stretch. And I think it's going to be longer than maybe we want to admit. And I think what we're going to have is less than optimal solutions in the short term that turn into more optimal solutions over time with work and trial and error, and it'll get there. It's just and this is the other thing to think about, is like, it's good that it's happening now, right? Because the space is nascent. It's not so nascent that it's going to kill it, but you don't want this to happen 5 years down the line when you have a ton of infrastructure and a ton of commitments and a ton of
it wouldn't happen then. Like, there would be so much lobbying power that it would be explosive. Like,
exactly.
There's like, at some point, there's a critical mass where you become a sort of easy to lobby or like industry, right?
That's right.
Because if you're small enough, you are really vulnerable. The bigger you get, actually, the less vulnerable you are.
Yep.
The more say you will have in things. So I think we wouldn't even, if this would have been continuing for another 2 years, they couldn't stop it anymore. Like, functionally, I think at that point it would be precedent. So then that will be, just par for the course again.
True.
Right.
True. Good points. Always good points, Sir Rez. Any final words?
It's continuing to look up for Ethereum for some reason. That's cool, I guess. I'm just looking at charts going like, fascinating.
Markets are, I mean, the market, not just the crypto markets, like the equity markets in America, S&P, all that. It's just, I can't make heads or tails of it, man. It's
we previously discussed how a lot markets become super rational as the number of participant grows, and then we're looking at Ethereum pumping 23% in the last 7 days.
I'll give you another one, dude. Amazon. Did you see like Amazon missed its earnings? And its price in 1 day on my ticker dropped 20%.
Whoa.
And then like the next day it like pumped back up. Like, that's a very good example of irrationality in the short term. Like, one bit of bad news and everybody says the sky is falling. The thing drops 20%. And then sure enough, the next day people are like, maybe we oversold this, and then start buying it back. It's just like, there is no end to the amount of examples you can give to an irrational market in the short term. So, Adam Smith, I disagree with you. Economist, I don't believe in the rational man. I believe in an irrational population of men and women over time. In the short term, geez, man, it's anybody's guess what happens.
Yes. So I think that's the quote for the end of the show. The markets can stay irrational longer than you can stay solvent. Thank you.
Catch you on the next one. Remember to ape responsibly. Peace, dudes and dudettes.
Cheers.